Good evening, everybody. This is Colin Casey and Tyler Silverthorne from Stonebridge Financial Partners. We're here to go through our mid-year outlook. We're very grateful that you spent some time with us this evening. Thanks for carving it out. We do plan to be with you for about 30 to 45 minutes. We do have the chat available on this webinar, so feel free to type in your questions if they are to arise. We're going to do our best with getting two questions at the end. What we can promise is if we're not able to answer the question this evening, your advisor will reach out to you to answer the question. Again, my name is Colin Casey. I'm a wealth advisor here at Stonebridge, working out of our Metro Detroit office. And this is Tyler Silverthorne, wealth advisor, also working out of our Metro Detroit office. We have a great presentation. If you're on with us tonight, that tells us that you are into the technical data. And what I can tell you is that Tyler does a great job of research for us here in the office. He's our research guy that everyone pretty much goes to, and he loves to put together economic information that we're going to be going through tonight. On our slide, you can see that we're pragmatically optimistic about this year, the rest of the year. So what that means is that we're hopeful that we're going to have positive performance in the overall market throughout the end of the year. And Tyler's done a really great job of pulling together information, sifting through the weeds of what's really going out there that he's going to present. We're going to go through economics, stocks, bonds as it relates to the Treasury, the Fed, and interest rates, a little bit about currencies, and then talk about the big, beautiful bill that just has come out with taxes to wrap it up at the end. So I'm going to try to interject with questions that I'm sure a lot of you are thinking as Tyler is going through this. But again, if you have questions as well, please use the chat box. And thank you again for joining us. So without further ado, Tyler.
Thank you, Colin. Welcome, everyone. So one of the main talking points tonight, obviously, is going to be the economy and the tariffs that have been in place, going into place, been changing. It's been one of the main drivers of the markets, of the news cycle, and obviously something that's, has been on everyone's mind, and what has the impact been. So when we look at some of the underlying economic data, and what we're looking at here is GDP growth as well as manufacturer index of, in essence, optimism. What we can see is that it's definitely been some slowdown in GDP growth in the first half of the year, but also a pullback in the manufacturer's confidence or belief in the economy. But then it's all kind of relative. If you look at, we see a big spike downward in 2020, with COVID, and a big spike during the recovery, and some stabilization. But overall, as we can kind of see looking back for the last 25 years, it's GDP growth has been hovering, between that 0 and 4%. So one of the questions is this just an anomaly for the last few months, or a start of a new trend? And that's always one of the questions that we are asking ourselves as investors and really as consumers.
An anomaly would be obviously because of tariffs and things like that coming out in the first half of the year. Is that right?
Exactly. And taking a step back, we had Liberation Day where tariffs were announced. They were in place for about 2 weeks, and then there was a pause that was extended into July, which then got extended again into August. And so it's really hard to say definitively what's been the impact of tariffs, because they haven't been in place for very long and they've changed several times. So I think what's one of the takeaways from tonight is there's still a lot of unknowns, and I think anyone that is making definitive statements about the state of the economy or the impact of the tariffs is doing probably misjustice because of there just not has been a sustainable amount of data for us to draw conclusions from. And we can kind of see that again, looking at the red line being what has capital spending being companies' investments into the economy have been compared to what do the CEOs expect spending to be over the next 6 months. So the blue line we're looking at is more of a forward-looking projection. The red line being actual what has occurred, and you can already see that there's a little bit of divergence of the CEOs are anticipating capital spending to be reducing over the next 6 months, but we're actually seeing capital spending over the previous few months have actually increased. So again, they are rather tightly aligned, but gives us insight to there's a lot of uncertainty about what's going to occur with the tariffs and ultimately the impact the tariffs are going to have on the economy, on consumer spending, on inflation, on economic or uh, quarterly profits. And again, I think CEOs are probably a little more cautious and are being a little bit slower to make, are projecting that they're going to be a bit slower to make investment decisions until there's more clarity around the tariff environment that we're going to be in. I would say that I'd safe to say some investment decisions from a corporate standpoint is being delayed until there's more confidence in saying this is the known environment we're going to be in. Another impact, and what's something we talked about a lot in the past, is inflation and the federal funds rate. As people recall, coming out of to help get through the COVID recession, Federal Reserve cut rates practically to zero. Inflation took off. The Fed responded by dramatically increasing interest rates. And then last year, for the first time since pre-COVID, cut interest rates a few times. Federal Reserve has said with tariffs coming down the pipeline, they want to wait to see what is the impact of the tariffs going to be on inflation. And we saw inflation continue to come down through March, April, May, and then June we saw inflation increase some. And it's been a big question on is the Federal Reserve, should they be cutting rates, holding tight? And I think they've been pretty steadfast in their stance of we want to wait until we see data from the tariffs being in place. And with having the pauses in the tariffs having occurred, it's been delaying them access to information to see the impact of tariffs. But I think overall, we do expect the Federal Reserve to still cut interest rates once or twice by the end of the year, but overall remain rather restrictive. I think we entered, this time last year, markets were anticipating the Federal Reserve would cut rates down to 3.25% by the end of 2025. And now the markets are saying interest rates will get cut down to 3.75% to 4% by the end of the year. So again, we're making progress on inflation when we start looking at over the last 12, 24 months, but inflation has been stickier than the Federal Reserve would have hoped for. And Colin, talking with clients about the impact of inflation on the cost of groceries to housing. What's the main feedback you're getting from clients that you talk to about how inflation is impacting them?
Yeah, I think the toughest thing for people, whether they're saving or if you're spending from your portfolio, is just the higher price of things, right? So inflation might be slowing down, but it's not like the prices are necessarily going down. So life is a little bit tighter, I think. You hear that? I think the Fed could certainly reduce rates. So people that are in the market to buy stuff, cars, houses. I don't think the Fed's going to be significantly reducing rates until we see some serious economic problems, per usual. That's my take on it. But I think generally speaking, people are also happy that their portfolios are a little bit bigger, right? So if inflation has been going up, also we've seen portfolios rise. So that's good news. So we've had just increased appreciation, if you will, in portfolios to kind of align, in my opinion, with inflation a little bit.
Yeah, and it seems, question on if or when the Fed should cut rates is it's a big decision that the Fed doesn't want to get wrong, and also, their mandate is inflation, but also employment. So their goal is, their mandate is to have an economy that has stable pricing as well as full employment, and the the employment data is starting to come back with some concerns. Right now we're looking at higher rates versus quit rates, and what we're seeing of, again, coming out of post COVID, it was a uh, workers' economy. The employees were able to negotiate higher wages. There was a great demand for workers. There was two jobs for every unemployed person. Since then, that has been dwindling. You're seeing now is that hiring has slowed down, but also quit rates have reduced, telling us that workers are now just are not as confident in their ability to leave their current job to go to a new job that will either pay them more or is better in, you know, the career that they desire. Uh, Another somewhat interesting of note, what we're seeing right now is unemployment rate for recent college graduates right now is close to an all-time high at 7.5%. So while unemployment rates across the entire demographic, has been pretty low, we are seeing increasing in unemployment amongst recent college graduates, which
Hmm.
which we'll get to a little bit further down. Question on is this a short-term trend, or are we starting to see the impact of AI, of jobs that recent college graduates would normally be going into are being replaced by artificial intelligence, or is this the result of what we saw earlier of CEOs being uncertain about the future, that they're just not hiring as many new workers because of uncertainty? So looking at, I think the unemployment rate of recent college graduates is a great example of saying, looking at, one, we can look at it from the view of AI and saying this is going to be a new trend going forward, or we can look at the CEO uh, investment projections and saying, what, this is just a reflection of CEOs saying we're anticipating spending investment within our companies to fall, and that's resulting in that we're just not going to be hiring as many new workers. But so it's a great, in my mind, example of depending on your view, walking with two drastically different conclusions, and remaining while quit rates have drastically fallen, wage growth is still higher today than it was pre-COVID, and real wages are still increasing uh, at a 4% annual rate. So when we're talking about the Federal Reserve goal of trying to get to a 2% inflation rate, that's going to be hard if wage growth is at 4%. Wages tend to be sticky. You know, companies might be able to hire in new employees at lower wages, but it's not very popular for companies to go to their workers and saying, well, it's a less employment friendly environment. We're cutting wages across the board. So wages tend to be stickier. So it's just a hurdle to achieve to the Fed trying to achieve their 2% target. I do personally believe that I wouldn't be surprised, given more time, the 2% target gets raised. That 2% target was set, and what the Federal Reserve will tell you is it's set based on the expectations of what inflation should be by the markets. And that expectation arose from an environment where we saw inflation incredibly low from the post housing bubble of 2007, 8, 9 to pre-COVID. Well, as age demographics and economies evolved, I wouldn't be surprised if the Fed eventually increases their target inflation rate above the 2% slightly. Um, but the wage growth is definitely a hindrance to the Federal Reserve target of a 2%. While great for workers, those retirees who are, they're not benefiting directly from wage growth, it just spurs inflation on. Uh, but has been coming down, but does seem to be stabilizing. Now, tariffs in more black and white terms. So what we see here is what were tariffs, the effective tariff rate in 2024, and what the tariff increase is set to be in 2025. I will say I think many of us have joked these are all subject to change. You know, the we saw this early on after Liberation Day, where tariff rates were changing on a rather frequently basis. And it seems, the administration's goal is try to get trade deals done, and ones that they're not able to get done in a manner that they feel, or in a time that they feel is reasonable, are issuing blanket tariff rates. But by the time we create the presentation till today, the trade agreement with Japan was announced. Um, we're getting information about trade agreements with the European Union. So I want to take this with a grain of salt, but overall, the point is we are expecting obviously to see tariffs increase. The net impact, though, won't be known for quite a while. While tariffs are increasing, that's not the full story. There are tariff havens. There's a ways around where companies can reduce or eliminate the impact of tariffs. And so while the tariff rates are definitely going up, how much goods will those tariffs be applied to is still rather unknown. But overall, we think as long as effective tariff rates uh, remain below 20%, recession risk will not materially increase. But obviously, once again, tariffs, it's going to continue to be in the news and one of the driving factors of the markets. Um, and when we're looking back in the start of April, the tariff news and the tariff rates were definitely the biggest driver of the markets and what resulted in almost or a 19% pullback in the S&P 500 from highs to yearly low was driven by the tariff announcements on Liberation Day.
Mhm. Yeah, I think one thing that's interesting just with tariffs, it's like anything else that businesses have to deal with, right? As long as there's clarity on what the deal is, generally speaking, that's what, they're in business to do is to make money and they're going to navigate that environment. But as long as they know what the environment is, they're going to be able to go out there and juke and jive and create the earnings that they're all driving for.
Exactly right. I think companies just want, before they make long-term investment decisions, they want confidence in what is the tariff environment going to be. So obviously we're all here as investors, so how have the markets been doing? So as I mentioned uh, earlier, we had a 19% pullback in the S&P 500. Any pullback above 15%, we call a stock market correction. If it's above 20%, it's a bear market. So the market went through a correction earlier this year, but did not go into a bear market. So looking at, historically, how has the S&P 500 done after it has experienced a 15% correction? And if we go back to looking over since 1950s of how has the S&P done post uh, stock market correction, over the 6 months post correction, the average return for the S&P 500 was 9.6%. If we look at a year after a stock market correction, the S&P 500 averaged 16.2% return. In both cases, in both time periods, the S&P 500 was positive 91% of the time, telling us that remaining invested after or during a correction is highly beneficial, and selling or trying to market time would result in missing out on historically very good returns from the S&P 500. Probably have heard us talk about Magnificent Seven quite a bit. We're looking at the overall S&P. What we're seeing is the Magnificent Seven, which is Google, Amazon, Apple, Meta slash Facebook, Microsoft, Nvidia, Tesla. So very heavy tech driven. Is those companies have been having very good uh, earnings growth. We see that especially in 2023 into 2024, those seven companies had very positive earnings growth while the overall market actually had negative. But we're starting to see those two converge. Starting in the second quarter of 2024, the earnings growth of those tech companies started to slow down, while their earnings growth within the overall market started to increase. And we're seeing that those converge more and more, which is a positive. It's telling us that it's not just seven companies experiencing growth within the economy, growth within the markets. It's the other companies, other industries are starting to participate as well. Again, we're looking at valuations. Valuations are still relatively high from a historical standpoint, very high if we're isolating that Magnificent Seven tech sector, well, if we exclude the Magnificent Seven, historical valuations get more in line, meaning, you know, just because these companies have been doing very well over the past few years doesn't mean we want to start becoming over allocated to those companies, start chasing returns. Because if we do believe in mean reversion and that stocks and the markets revert back to their historical averages, it would tell us that the non-Magnificent Seven companies are poised to do a bit better going forward than these companies that are already have higher than normal valuations. And we can see, just looking at how have these stocks done, looking from November 5th to July 11th, we're seeing, okay, the S&P had an 8.2% return. The Magnificent Seven had, twice that return, almost at 16.1. One outlier being Apple. Apple had within that Magnificent Seven has actually been negative 5.5%, which is a bit surprising. But they are positioned to be more impacted by tariffs than the other Magnificent Seven, and sitting on all this cash that they have has not helped them either. It's investment that's just not being deployed in a useful manner, and they really don't have announced any plan. And what are they going to be doing with their billions and billions of cash that they have been accumulating? And Colin, I found this to be interest. This graph to be interesting. It's a bit noisy, but what it's talking about is how sensitive have the markets become. And by sensitive, we're saying how much do they move uh, intraday and within the week. And what it shows is, looking at pre-COVID to post-COVID, is that in essence the markets are twice as sensitive over the last 5 years as they were over the previous 16 years. Those 16 years including the volatility and daily drops during the 2007 and 8 bear market. So what we're seeing is that the market's moving a lot faster. And being in our shoes, I think it's interesting. Obviously, this is what we do, but from an investor standpoint, Colin, how are you seeing? Are you seeing difference in behavior changes from clients, from how they view or discuss the markets today compared to 10 years ago?
I think that from 10 years ago, the planning software that we utilize for our clients has come a long way, just with computers and technology and everything. So for the ability for us to plan quickly and precisely with technology ahead of time, that's really helped with properly positioning portfolios customized to people's lifestyle. So I think generally speaking, we were able to, with confidence, position portfolios in the right way in today a lot better than we could 10 years ago. And then with that said, with the extreme volatility and things moving so fast, the good news is that we're positioned correctly to navigate those times. So I think for the most part, people are becoming more used to the extreme ups and downs. But from what I have found with the planning, when we do have those conversations with clients, we're able to positively reinforce that we're already set up to navigate and stay the course, and based on your slide here, things generally speaking, and just like a couple slides ago, when we see those correction territory volatility times, like things have picked up and they come back. So Luckily, most of the time, almost everybody stays the course, but we're really able to articulate why we want to stay the course way better, I think, today, more so than 10 years ago. So that'll be my take on the day to day.
Yeah, I think you know, information travels faster, right? If you go back before our time, people had to call a broker who had to look at a ticker tape to get a stock price, to going online to being able to trade on your phone, to um, that with the information moving faster, natural the markets move faster, which provides an opportunity and a risk. I think to your point, our opportunity is being able to take advantage of people who overreact to market information uh, by us staying more sound and holding to fundamentals, and not getting caught up in the noise of the markets. But I definitely feel that this is a trend that's going to continue. That markets will continue to move at a quicker pace, and something we'll have to adjust to. Oop, wrong way. Bonds. So looking at the treasury yield curve. So this is the difference between the 2-year yield and the 10-year yield. Historically, the longer dated the bond, the higher yield that bond should pay. If I'm going to give my money to company ABC for 10 years, I would expect, because they have my money longer, they're going to pay me a higher rate than if I give it to them for 2 years. Uh, for, you know, 2 years after COVID, the yield curve was inverted, meaning we were getting higher rates on short-term bonds than long-term bonds. In end of 2023, we saw that invert or revert, or steepen, which is a positive. Typically, when shorter term bonds are paying higher rates than longer term bonds, it's because people are less confident in the economy or in the stock market and are fleeing to safety. So it is a positive sign that the yield curve continues to steepen, meaning that longer term bonds are paying a greater rate than short term uh, bonds. And this is looking at the federal funds rate that we spoke about earlier. We see that post 2008 rates were at zero for a pretty long period. Did start seeing interest rates increase uh, at the end of the Janet Yellen Fed, in which current Fed President Jerome Powell continued until really COVID, and we saw the rates go back down to zero, and then again, dramatic increase. So we are projecting some more rate cuts, not as many as we were projecting at the beginning of the year. Something that is interesting, we're talking about interest rates, is last year when Jerome Powell and the Federal Reserve did cut interest rates, bond yields actually increased. So this idea of, well, let's cut rates, and worst thing that can happen is maybe inflation remains stickier, actually didn't come isn't the full risk. If the Federal Reserve cuts rates before the market believes they should, which happened last year, yields actually increase, which is the exact opposite of what should be happening when interest rates are cut. And so what occurred last year, in that the Federal Reserve cut rates, but yields increased, is I do think weighing in on the Federal Reserve's mind when deciding if they should cut rates now. Is that we experience, if you cut rates before the market expects them to, believes that they should, will actually increase yields, not decrease them. one of the big stories. Normally, currencies are not something we talk about. You probably don't hear us in our meetings. I don't know, Colin, how often do you bring up the value of the dollar in or currencies in meetings? But it's not probably very frequent.
Well, it's not very often. I think the question comes up from time to time on, is the US dollar going to be, the denomination that we do financial transactions in? Like that question comes up a lot, that if that's ever going to change. Should I hold my cash in the bank, like in my mattress rather than at the bank? Maybe those are probably the most common dollar questions that come up.
Yeah. So the value of the dollar has fallen 10% uh, since the beginning of the year, which is a significant drop in value over a time frame. But I think it's needs to be taken within bigger context. So when we look at the value of the dollar, and anytime we come about the value of the dollar, it's always valued against another currency. So how is, if the dollar is weakening, it means another currency is appreciating. Uh, the dollar index that we're looking at here is just a blend of how the dollar doing across, on average, the major other currencies, the euro, the Canadian dollar, uh, the Japanese yen, etc. And what we're seeing is definitely saw a big drop in value over the last 6 months, but we start expanding it out. It is above levels, the average level that we saw from 2016 to 2022. And so while it has weakened, it's still above, you know, its historical longer average. And, what we're seeing here is this testing a support area. What we're seeing is that it keeps hitting its current level and then recovering. And then to go back to what you brought up of, is the dollar losing its status in the world? And in my opinion, the answer is really no. Uh, Looking at data from 2024, we see that almost 85% of all global currency transactions, the dollar was involved in on one side of the transaction, compared to the euro being involved about 30, and then the Chinese yuan being involved in less than 10. So the dollar, while it has fallen in value over the last 6 months, still heavily utilized uh, by the global community. And there's multiple reasons for that. One, while it has fallen, it's incredibly stable compared to other currencies, and the dollar is the only currency that has the volume that can really take care of the or handle the volume of the international currency transactions. Again, start looking back at the this is looking further beyond but the long-term value of the dollar, is that it's been in an upward trajectory really since the end of the 2008 financial crisis. So again, while the dollar has fallen 10%, as you can see, it's still higher than the levels it was in the early 2000s, in the early 2010s. And has overall been in an upward trajectory. So while it's definitely something to taking note of, something you're probably hearing in the media, if you are watching a lot of economic news, it's in our mind it's more of a footnote than a long-term risk at this point, but something that we are paying attention to. Colin, I know we could done a whole webinar on itself on the One Big Beautiful Bill Act. that was signed 4th of July. But you want to take us over some of the key highlights.
Yeah. So we put together a few slides here on the takeaways that we see that are most important for our clients and what we're working through most of the time on a daily basis with most of you. So you can see here we have some personal provisions that have become permanent. So we do have the extension of the 2017 the Tax Cuts Jobs Acts, tax brackets and tax rates. So basically, we saw an extension of what the current tax rates are they're permanent now. So generally speaking, we're in lower tax situations than if it were to refer back to the way it was before. Um, for people, a lot of times we've been working through Roth conversions and things like that, managing tax brackets, both on the savings side and also on the withdrawal side. So generally speaking, I think we're going to find most of our clients are in a more tax-friendly situation with the extension of those brackets. Um, we have the increased child tax credit from 2,000 to 2,200. I just had a baby, so that's awesome that we see the 2,200 per child credit there increase. And we also have the established additional charitable deduction for 1,000 or 2,000, whether you're single or married filers who utilize the standard deduction. So we saw this early on in the 2017 TCJA, where if you take the standard deduction, you can also get an additional deduction if you give money cash to charities. My understanding is that's going to start in 2026. So if you're taking the standard deduction and give cash, that's a next year thing, but that's pretty cool to get a little additional benefit. There is also the increase in the estate and gift tax exemptions. So for very higher net worth people, you got $15 million per individual and 30 for a married couple. So you don't have to worry about estate or gift taxes unless you have more than that. Some more temporary. So we have from 2025 or 2026 through 2028 to 2030, a couple other things. So there is an increased standard deduction for 2025 to 2028. So you get an additional 1150 for single or 2300 for married. For those that are 65 and older, there are some phase outs for income, but there's going to be an additional $6,000 standard deduction. I think for most that are retired, that's going to be helpful. So additional tax deduction there. We have the tax on tips. So for the first 25,000 tips, you get above the line deduction, basically tax free. Starts to phase out if you're making more than 150,000. There is an above the line deduction, 12,500 or 25,000 for married people for overtime pay. So you get a tax free for overtime pay. On those amounts starts to phase out for higher income earners. And also, there's a up to $10,000 for new U.S. assembled passenger vehicles where you can deduct the interest via itemized deduction. So if you're not itemizing, that's not going to necessarily help you, but you can deduct some auto interest to help with the higher price of vehicles that we're seeing today. The SALT cap went from 10 to 40, so state and local taxes, if you're itemizing, it increased from 10 to 40,000 for the um, high tax individuals. And then for 529s, you can use K through 12 for private education. There's a cap. They used to be able to spend $10,000 a year on that. Now it goes up to 20. Generally speaking, the 529 is best used for college, but you can access it for that purpose up to 20,000. For our business owner clients, the 20% qualified business income deduction pass-through is now permanent. The permanency for increased on the gross asset limit and the per issuer cap on qualified small business stock. Basically, if you sell a business, there is some tax deferral that you can get for the capital gain. So if you're a business owner, you're looking to sell, there's some deferred taxes that you can take advantage of over a 3 to 5 year tiered period. There's bonus depreciation of 100%, which is reinstated. So Capital expenditures can be depreciated up to 100%, which I think is exciting. And then also there's an increased cap on Section 179 bonus depreciation to $2.5 million.
And I think you mentioned, these are just some of the highlights. There's a lot more specific, industry specific, or individual specific, but we just wanted to touch on some of the main changes that impact, our average clients. Well, like to thank everyone that was able to attend. Trying to adhere to our time limit. So the questions that we have, we will be following up with you individually. I would like to thank everyone who was able to attend and look forward. Hopefully, we're cautiously optimistic about the next 6 months. But know that if you have any questions, concerns, always reach out to your advisor.
Thanks, everybody.